All right, so today we're looking at revenue. What's going on here? It's the last section of work, and then we'll be done, and then we can spend the rest of the 4 lectures doing past exam questions. Revenue is a new standard that was issued a little while ago, IFRS 15. IFRS 15, and it's one of the latest ones. If you recall, we looked at fair value, which was IFRS 14. Do you remember? This one was issued after that, IFRS 15, revenue. And this IFRS 15 of revenue deals with the whole principle of revenue recognition. So revenue is all about recognition. It's not so much about definition, because definition of revenue is income, basically, from framework. But it deals with the steps for recognition of revenue. And there are 5 of them, 5 steps. You have to follow all 5 of the steps, and once you've done that, then you'll be able to recognize revenue, only once you've followed all the 5 steps of revenue recognition. The first step of revenue recognition is to identify the contract. In order to identify the contract, obviously we need to have a buyer and a seller. We need to have the parties to the contract. We need to be able to identify each party's rights and obligations, in terms of this contract. Usually the seller has an obligation and the buyer has a right, isn't it, to receive goods. We need to identify that there is a probability that goods will be transferred between the two. So it's just really the first step of identifying the contract. When we look at this contract story, there's a little bit of a little additional thing which has to do with modifications to contracts. When we have modifications to contracts, we look at 2 things. So I just want to move that down a little bit. We look at whether the modification is a new contract or whether it's an existing contract that's being modified. So, for example, they use the example, we're going to look at some examples, I think, of, let's use the example of lectures. Let's assume that you've signed up for lectures, and as you know, then EVI comes up with these crash courses, isn't it? And you can go and apply for the crash course if you have done lectures. But you'd have to pay more, isn't it? There's a little, like an admin amount that you have to pay. So in that case, it's a modification to the existing contract that we have, but it's an increase in price and it's an increase in deliverables, isn't it? So we consider that to be a new contract, and that's how it would be accounted for, completely separate. Yeah. If the modification was just an existing contract, the contract that we already have, and we just modified it. So let's assume that we say, because they have reduced or they've extended the exam dates to later, we're going to add a few extra lectures, isn't it? If it's an existing contract, and the existing contract, the goods and services are not distinct from what we've already done, so we're just going to add some extra lectures, and maybe that's not really distinct from what we've already done, then in that case we do this thing called a catch-up. So what we would do is we would take the fees that you've paid us, and we will say those fees we had said were for 13 weeks, now it's going to be for 15 weeks, and we fix it. Yeah, we catch it up. If the extra time is distinct, so in other words, if we can distinct it or separately identify it from the rest, like a crash course would be distinct, for example, yeah, then we would actually separate it. So we would take the income and we would say, okay, the income that we've received, this much is for the 13 weeks, this much is for the crash course, and we would separate it and account for it separately. So modifications, I don't know if you're going to come across those, but it's the biggest issue around that step one when we're looking at the revenue recognition, or when we're looking at that step one, which is to identify the contract, is this whole issue of modifications. So we're going to look at some examples. Maybe we can look at the examples as we go. Now, I wanted to just give you a big picture. So I'm trying to just give you a big picture, and that's the only issue really there. Then step two of the contract is to identify the performance obligations. In terms of the contract, in the beginning there I said we're going to say that the seller has obligations, the buyer has rights. We need to identify performance obligations. When we're identifying performance obligations, there could be one or there could be many, and we need to identify, is there one or are there many? Because later on we're going to try and take the price and allocate it to the performance obligations. So again, as an example, if when you signed up for lectures plus the crash course, we would say that there are two performance obligations, lectures and a crash course, isn't it? And then we would take the revenue that you've paid and split it between the two. So that's step two, is to identify your performance obligations. Step three is to determine a price. And the price is usually in the contract. It needs to be something that's measurable, obviously, in terms of recognition in framework. We determine a price, usually in that contract. And then step four is to allocate the price to the performance obligations. So step four, if there was one price and many performance obligations, step four is the process whereby we allocate price to performance obligations. And we're going to look at some examples of that. Step five, the last step of revenue recognition, is to look at when the performance obligations are satisfied. I'm going to say performance obligations are met. And they talk about three different time periods when performance obligations can be met. Where's my, oh, it's here. Just want to move that down a bit. They talk about three different time periods or ways that performance obligations can be met. Either when control is passed, control is transferred. This is usually for goods. So if I'm selling a car, when you take the car and drive it off my lot, it's your car. Do you agree? Control has been transferred. It could also be at a point in time. And this one is more for services. These last two are more for services. Let's assume that I am paying for advertising. When that advertising is delivered, when the advert runs on the radio or on the TV, when it appears in print in the magazine, that's when I can recognize that revenue, isn't it? If I'm the TV station or radio station. And then the third option is over a period of time. And this would be something like a construction contract, where as you build that house, you can recognize revenue as you go. Or it could be lectures. as I provide the service over the lecture period, we recognize revenue as we go. Yeah. So performance obligations are met. I determine when they are met, these ones that I had identified here, and then I can recognize revenue. So you can see the 5-step approach. Identify the contract that exists between the two parties. Identify what performance obligations there are in that contract. Determine what the price is. Then take the price and allocate it among the performance obligations. And then determine when those performance obligations are met. So once they are met, I then have allocated the price to the obligations, and I then can then say this is revenue or this is not revenue yet. Okay, so in your study guide there are a lot of examples. Because it's a new standard, they have gone into a lot of detail with examples. So we're going to look at some of these examples. The first page that I've put up is where we're talking about the modifications, but I wonder if there's an example at the bottom here. Yeah. So you'll see the first example is we're looking at step 1. We're looking at these modifications of the contract, but we're going to look at an example to understand that. You'll see that they've talked about if the remaining services are distinct or not distinct, and yeah. Anyway, I can't, this thing doesn't even want to move. We're going to look at this example. Example 1, it's on page 206. 206. Okay, so it's the last unit in your study guide. A construction company entered into a contract to construct a commercial building for a customer on customer-owned land for R1 million and a bonus of 200,000 if the building is completed within 24 months. The entity accounts for the promised bundle of goods as a single performance obligation satisfied over time because the customer controls the building during construction. So we've identified a contract. The seller is constructing a building for the buyer. We've identified a price. The price is R1 million, and there's a bonus of 200,000 rand, which we may or may not get. Do you agree? So that one is conditional. It's conditional on the building being completed. So whenever we have these conditional revenues, we have to ask ourselves if there's enough certainty that it will be met. If there isn't sufficient certainty, or I suppose, let's use the word in framework, probable. Is it probable that we will get that 200,000? If it is, we can put it in. If there's doubt, we can't, isn't it? Because we can't recognize it as revenue then. The entity accounts for it as a single performance obligation. So there's step 1, 2, and 3, isn't it? So here's step 1, the contract. Here's step 2, the price. There is step 3, it's a single performance obligation. They've identified it as one obligation. At the inception of the contract, they expect the following. This is what they're going to charge, R1 million. The costs are going to be 700,000, and they're going to make a profit of 300,000. Okay. All right, so let's see what happens with this contract. At contract inception, the entity will exclude the 200,000 rand bonus from the price because it cannot conclude that it's highly probable that a significant reversal will not occur, right? So that's what we're looking at. We're looking at probable. If it's not probable that we won't have to give the money back if we get it, then we don't put it in. Completion of the building is highly subject to factors outside of the entity's influence, including weather and regulatory approvals. So things like getting approval for the building to start happening from the councils, etc. Things like weather affect the ability to finish on time. So we don't believe that it's highly probable that it won't be, that the revenue won't have to reverse. The entity determines the input measure based on costs is an appropriate measure of progress towards completeness. Do you agree that this is going to be one that we're going to measure that obligation over a period of time, isn't it, as we build the house? And what they've said is that they think that the costs incurred as a percentage of the total costs is a measure of how far we are with the contract. Yeah? That's one way of doing it. There are other ways. We could get a surveyor, isn't it? A quantity surveyor to come in and do it. There are many ways of doing this over time measure. So we have to look at what the client said is what they think is the best measure. By the end of the first year, they've satisfied 60% of the performance. They've spent 420,000 Rand out of the 700 that they had estimated in the beginning, and so they are 60% complete with the project. The entity assesses the variable consideration and concludes the amount is still, okay, never mind that. And so at the end of the first year, we will recognize 60% of the revenues, 60% of the costs, and 60% of the profit, isn't it? Revenue recognition at the end of year one, when we're preparing financial statements, this obligation, it's a single obligation, is going to be met over time, yeah? And so we've considered that we have met 60% of that, and so we recognize 60% of revenue. Then here's the modification. In the first quarter of the second year, the parties agree to modify the contract by changing the floor plan. As a result, the costs will increase by 120 and the price will increase by 150. So because of this modification that they've decided to agree with the client, we're going to increase price by 150 and costs will go up by 120. Total potential consideration is therefore 1350, which is the 1150 and the 200 bonus. And then total costs is then the 120 plus the 700 that we had, 820. In addition, the allowable time for achieving the 200 bonus is extended by 6 months to 30 months. Now they've extended the time that we have to finish the building. At the date of the modification, based on its experience and the remaining work to be performed, so essentially we're only a year in. Yeah, we've already done 60% of the work, so there's only 40% left. And we have still got 18 months to do it, isn't it? Because we're only 12 months in. So after 12 months, we did 60%. Now we have 18 months to do the remaining 40. It's starting to look like the 200,000 is probable that we will achieve, isn't it? So that's what they say. They say at the date, based on the experience and the remaining work, which is primarily inside the building, because by now the building structure's up, and not subject to weather conditions, because when you're working inside, floors, windows, etc., it doesn't matter if it's raining. The entity concludes that it is highly probable that they won't have to reverse that, and so therefore now we will include the 200,000 Rand in the transaction price. And so they then also say that the modification is not distinct from the goods and services transferred before. In other words, we're just changing the floor plan. It's difficult now to say, what's the extra that we're doing? We're not doing extra really. We probably, it's just the rooms that are moving around. So they're also saying that it's not distinct from the goods and services that were done before, and so therefore it remains a single performance obligation, and so now we have to do the catch-up, isn't it? Do you remember that? So consequently they account for it as part of the original contract. They measure the progress and estimate that it has satisfied 51.2% of the entity. Okay, so at this stage now, we've incurred 420 of costs. Do you agree? That's what we had incurred. But now total costs are actually 820 because my costs are going up by the 120. So my percentage now is 51.2. I'm going to recognize 51.2 of revenue, but now my revenue number is, what was that number? 1350, isn't it? It's no longer 1 million. So I will now recognize additional revenue because I'm going to recognize, where's my highlighter? I'm going to recognize 51.2% of 1350, the original million, the extra 150 for changing the floor plan, and the 200, which I now believe I will get, 1350. And so therefore, if I do 51% and 1350, I get, the number that I get is 691,200. You can do that calc for me. 1350 times 51.2%. Is that what you get? 691,200. And so therefore, at this date, at the date of the modification, I'm going to account for additional revenue of 91,200. Because I had only recognized 600 of revenue, but now according to my revision, I've revised costs, I've revised percentage completion, and I've revised price, and so now my revenue changes. So this is an example of a contract that is modified where we catch up. Yeah? So the goods and services are not distinct and we catch up. Okay, there's an additional example. Is it at the bottom? I think that I'd reached the bottom. Okay, the next example is on example 2. It's also to do with a modification. Page 209. No, I think this one is not, it's step 2. It's to look at the different obligations. Okay, so example 2 has to do with step 2, is that right? In your study guide, it follows after step 2. Okay, so example 2 has to do with step 2, and step 2 was, if you recall, identifying performance obligations. How many performance obligations do I have? So, Hilo is a software developer. They enter into a contract with Flow to transfer a software license. So here's all the pieces. A software license to perform an installation, to provide, to service and provide software updates, and to do technical support for a 2-year period. 1, 2, 3, 4 obligations. Do you agree? 4 obligations. Hilo sells the license, the installation service, and the technical support separately. So if you went to Hilo and you said, I only want the license, they would sell you just the license. If you went to them and said, I want just support, they would give you just support, isn't it? They don't do it as a bundle of goods. When we're looking, for example, at a car that comes with a maintenance plan, isn't it? It's a similar thing, because the selling of the car and the maintenance plan are 2 separate things. If you wanted to just get a maintenance plan, you could do that if you already had a car. If you wanted to get the car with no maintenance plan, you could do that. So the installation service includes changing the web screen for each type of user. It's routinely performed by other entities and does not modify the software. The software remains functional without the updates or the technical support. So they're not even linked to each other. You can keep that software and it'll work. It's like when we're running, I don't know, I have computers at home where I'm running like old Windows because I don't want to change it to the new ones. And like old Excel, isn't it? And it doesn't matter, it still works, right? Even though now it's, I don't know how many versions ahead. So they need to assess to determine which goods or services are distinct, and they conclude that they can benefit. It says here, they conclude that they can benefit, and that's what we look at, whether the company can benefit from each of the goods and services on their own or together. So they're going to conclude, can I only benefit if the goods and services are together, or can I benefit from them on their own? Yeah. And so they conclude that they could benefit from them on their own, because they could just buy the license and install it themselves, or they could just get them to come and do the installation and buy the license from somewhere else, isn't it? So they consider this, and yeah, they go into a whole lot of discussion, and so they then identify 4 performance obligations in the contract, and these are the 4: a software license, an installation service, a software update, and technical support. When we get to step 5, we have to look at how these performance obligations are met. The license is when the control passes, when they've signed and you've given them the password. We don't even give licenses physically anymore, they're downloaded, isn't it? When we give them the code, then they can download the license. The installation is at a point in time, isn't it, when it happens, when I go in and do the installation. The software updates are also when control passes, isn't it? A year later, when I update, I give them the code for the new update. And then technical support is overtime. Yeah? So it's important to take the price, whatever price it is that we've agreed, and to actually identify what belongs to which, because we're going to recognize those quite differently, isn't it? So if they've already paid for software updates later, then that I have to keep aside, because that I'm not going to give them now. Yeah? I saw it was a CTA level question, which was for a cell phone company. And it was, you know, when you pay for your contract on a monthly basis, when you do a contract, some of what you're paying for that contract is free minutes, some of it is data, isn't it? And some of it is to pay for a phone, which you receive right at the beginning, isn't it? So we have to take that money and we have to split it, if you're a cell phone provider, among those three items. And you actually will recognize revenue today for the phone, the unit, that you will only receive over the next 24 months. So you need to like PV it, because then there's interest as well. So it's something that is quite common, depending on the, you know, especially in this kind of business. So example 3 is now one where the goods and services are not distinct. So this one is a contractor, so it's similar to the first one, that's building a hospital. And they're responsible for the overall project management of that hospital. And they've identified various goods and services that will be provided. Engineering, site clearance, foundation, procurement, construction, piping, installation of equipment, and finishing. What they say is that the goods and services, they say it over here, the goods and services that are not distinct within the context of the contract, because the entity is providing it as one thing, isn't it? One whole contract. So because of this, the contract is considered to be a single performance obligation. It's quite difficult to agree for somebody, for the people who own the hospital, to make use just of the piping and the wiring without everything else that goes with it, isn't it? So it's either a finished hospital or it's not, and if it's not, I can't use it, isn't it? It's not like when I have a software license and I can still go get somebody else to install it, or I can install it. So this, although there are lots of different pieces identified in the contract, when you look at them, they are really one obligation, which is to build the hospital. They continue with this example. Oh, I thought they continued with the example. I thought there was a thing about building kitchens. Maybe it comes later. Step 3 is the transaction price. There's an example, which is example 4. This is an important one. So in your thing there, put NB, because this one now has to do with number crunching, right? So the other two were more discussion, do you agree? And I think for your purposes, it's more just for information. This one is one that you would be asked to do. You can see the journals on the next page, yeah, of the handout, of your study guide. So this one is NB. This one is one that you would need to be able to do. So XYZ sells a trailer to a customer for 121,000 Rand. It's payable 24 months after delivery. Unusual. The customer obtains control at contract inception. The contract permits the customer to return the trailer within 90 days. The trailer is new, and XYZ has no evidence about product returns. They don't know if within 90 days something's going to go wrong and the product will be returned, or whether it won't. Okay. The cash selling price of the trailer is 100,000 Rand, which represents the price that a customer would pay upon delivery for the same product. And the cost of the trailer is 80,000. Okay, so the first thing that we identify is that we've got this 21-month story. This 24-month story, this 24-month story has meant that instead of paying 100,000 Rand, the customer is going to pay 121,000 Rand. Do you agree? So do you agree, therefore, that the 21,000 Rand is actually interest? And it will be interest that will be recognized over the 24 months. Okay, so as a starting point, we have 21,000 Rand of interest, which will be recognized over the 24 months. And we have a trailer, which will be recognized when control passes. Okay. We now have this additional problem, which is that this trailer can be returned within 90 days. And because we don't know, there's a question mark about whether we think it might be returned or we think it won't. We don't have evidence that it's probable that it won't happen, isn't it? If you could say it's probable or highly probable that it won't be returned, then we could just recognize the sale immediately. But because we have no idea, we cannot recognize the sale immediately. What we do recognize immediately is that we gave someone a trailer. Yeah. So when you look at the journals are there on the next page. We recognize that we gave someone a trailer. We gave them an asset. It needs to come out of inventory. Yeah? So we need to credit inventory. So at the time that we give them the asset, we credit inventory. But we cannot yet recognize revenue because we have that 90 days uncertainty. So at that stage, what we do is we recognize this asset. It's an asset for a right to recover a trailer that could be returned. So we have a right to recover a trailer if the customer doesn't like it and wants to return it within the 90 days. I don't have inventory anymore, isn't it? Because the inventory is not in my books. So that's why I do this entry. I credit inventory and I debit this asset for the right to return the trailer. Then, 90 days later, so this is at the date of the sale. 90 days later, I then can recognize revenue. And now I will recognize revenue for the 100,000 Rand. And the other side of revenue is a receivable for the 100,000. Debit, receivable, credit, revenue. And at that stage, I also recognize cost of sales. My normal entry for cost of sales is debit, cost of sales, credit, inventory. But because I already credited inventory, my credit now goes to that asset for the right to recover. And these journals, I have seen asked in an exam, these exact journals, okay, which is when I sell goods and there's a right to return them, and I'm not sure, I don't have high probability that the goods will not be returned. So at that stage, I do not recognize revenue there because the performance obligation hasn't been met. I only then recognize it here, which is when really now control can't come back to me. Because if you recall my very first notes, I had it at the bottom here. Performance obligations are met, and I said that for goods, its control is transferred, isn't it? Control normally is transferred when delivery happens, isn't it? When it's that whole thing in law, which is the whoever has possession. Possession is 9/10 of the law, isn't it? What they say. So, but in this case, the other party has possession, but it's almost like he has it on a trial basis, isn't it? He's got it to see, and then if he doesn't like it, he takes it back. All right, so that's an important one. Example 4, that journal. We're still looking at price. Are we, or are we already moving on to, because there's a piece with discount. We're already looking at 4, not yet, still 3. So we're still looking at price, we're looking at discounts. And this you remember from second year. In second year, or first year even, you dealt with what we do with discounts and volume discounts or settlement discounts, isn't it? And if you remember from even first year, we offset discounts against revenue, isn't it? We don't show discounts as an expense. We show revenue as a smaller amount because of discounts. So this is one of those. LOL enters into a contract with Chat to sell cell phones for 100 Rand a device. If Chat purchases more than 1,000 phones in a year, the price is reduced to 90 Rand per device. Consequently, the consideration is variable. So we're not sure if the price will be 100 or 90. I imagine that we're selling it for 100. When they hit that 1,000, we have to then give them a discount, isn't it? Or give them like a credit note, which then they can offset what they owe us. For the first quarter, they sell 75 phones. I mean, 75 for a quarter, they're never going to reach the 1,000. Do you agree? I mean, a quarter is 3 months. We would at best be timesing that by 4. Even if it was 100 and we times it by 4, it would be 400, isn't it? It doesn't look like they're going to achieve. And so LOL at that stage will take the 75, they'll multiply it by 100 Rand, and they'll recognize revenue of 7,500 Rand. Yeah, so here's the revenue they're going to recognize in the beginning. 7,500 Rand for the first quarter. Yeah. But then what happened is that in the second quarter, in May, Chat did a merger. They acquired another company. And after they acquired that other company, they now suddenly are selling many more phones, right? And so in the second quarter, LOL sells them another 500 phones. So now suddenly it looks like they will meet that 1,000, isn't it? Because in quarter 1 they sold 75. In quarter 2 they've sold 500. They only need to sell more than 1,000. So now it looks like they will meet that 90. So now we actually need to go back and do a fix, isn't it? So we need to go back and do a fix. So the fix is that we will... Yeah, I don't like the way they've done that fix. I'll do my own fix. Let me just see what they do here. No. They do like a funny calculation. But for me, the calculation is quite simple. We're going to say 575, which is the total number of phones, at 90 Rand. Yeah. What does that work out to be? $517.50. Is that right? We had previously accounted for 7.5 in quarter 1. And so therefore, in quarter 2, we will account for 44,250 in quarter 2, which will include that adjustment. Let me see what they say. Yeah, they have it. They will recognize in quarter 2, 44,250. And they've said the amount is calculated based on 45,000 less the change of 10 Rand per device. But it's easier to do like that, isn't it? Catch up. So we say, what should revenue be for the year so far? What have I recognized up to now? What do I need to fix to get it correct? And so there's your volume discount. Then the allocation. Allocation. Example 6. So now we're looking at step 4. Is it? Yeah, step 4. So I knew that there was a discount on both of them. All right, so example 6, we're now looking at step 4. So we've so far looked at step 1, which is to identify a contract, and we looked at an example with a modification. We looked at step 2, which was identifying performance obligations. Do we have one? Do we have many? Yeah, we ask ourselves a question, can the customer use each one of the separate things separately and get benefit from it separately or not? Step 3, identifying a price. We looked at 2 examples, one with a contingent amount that we weren't sure if we were going to get or not, isn't it? And it also had a modification. And then we looked at this one, which had the volume discount, which was also almost like a contingent amount, but the other way around, isn't it? Where we now revenue will drop instead of go up. We're now looking at step 4, which is when we're allocating that price to the various products that we identified. So allocating step 3's price to step 2's products that I'm selling. So they say an entity regularly sells A, B, and C individually. And they have the following prices. 40 Rand for A, 55 Rand for B, 45 Rand for C. And they charge 140 Rand. In addition, they also regularly sell B and C together. When they sell B and C together, they sell that for 60 Rand. Okay? So they've given you different scenarios. In scenario 1, case A, the entity enters into a contract to sell A, B, and C for 100 Rand. So 100 Rand is what we're going to sell it for. If we looked at the previous page, we saw that when we sell A, B, and C separately, it's 140 Rand, isn't it? 140. So there's a discount of 40 Rand that we need to allocate between A, B, and C to get the price allocated correctly. Yeah. So the first option always is to use market values to try and allocate that price. If they hadn't said anything to us about B and C being sold together, we would just take those market prices, A, B, C, and we would just take the 40 Rand and proportion it. But because they said to us that C gets sold for 60 Rand, we're going to do a calculation where we say product A, where is A? How much is product A? Is A 40? Oh, okay, so we don't have any more discount. So what we're going to do is we're going to say that we're selling product A for 40 Rand and we're selling product B and C for 60. That adds up to the 100, isn't it? So the discount that we're giving, we have to allocate to between B and C. So the 40 Rand discount that we're giving, we would have to allocate between B and C. So when we're looking at saying B and C together is 60, the original price for B and C, the separate price was what? 55 and 45, yeah? We're going to take 45 and 55 and we're going to use that to take my 60 and split it between the two. Where am I now? Why is this misbehaving? Okay, there we go. Yeah, but I don't want to be way up there. I can't reach. There we go. All right, so if we had a look at what we had here originally, it was 55, 45, or the other way. 55, 45, 100. So I have to take that, and I have to say that the 100 will be 60, so therefore what will those two be? And it's just a proportionate. So I say 55 divided by 100 times 60, and I will get that one. 55 over 100 times 60. And then for this one I will say 45 over 100 times 60. And the percentages, it was straight percentages because that added up to 100. So basically you're saying 60 times 55%, 60 times 45%, isn't it? So now when we're looking at the prices, we're going to say for this contract, we're going to sell A for 40 Rand, we're going to sell B for 33 Rand, and we're going to sell C for 27 Rand, and that adds up to the 100. And it's important to do that step. Why? Because maybe the performance obligations for A, B, and C are going to be met at different times, isn't it? And so I'm going to need to know how to recognize that 100 Rand. Make sense? I don't know if they actually have that. No, that's what they have. So in case 1 then, I have a contract to sell A, B, and C. I'm going to sell for 100 Rand. I'm going to sell, I usually sell B and C together, so I'm going to say that B and C together would be the 60 Rand and A would be the 40, that's my 100. But I need to split that 60 Rand between B and C, and so that's my split. Make sense? Okay, so this is using market prices. Okay, I think B looks at residual. Entity enters into a contract to sell A, B, and C as described in case A. The contract also includes a promise to transfer product D. The total consideration for the contract is 130 Rand. The standalone price for D is highly variable because the entity sells D to different customers at a broad range of discounts of amounts. So they sell product D to many different customers, depending what the customers have bought, for different amounts, from 15 Rand to 45 Rand. So therefore, when we're looking at what to put in for D in this scenario, we use what they call the residual approach. Because we are unable to determine a market price for D, when we are unable to determine a market price, we use this residual approach. It's on the next page. And so the residual approach would be to say, I normally would sell A for 40, I normally would sell B and C together for 60. So if I'm selling all four for 130, therefore I'm selling D for 30. Yeah, residual approach. So in that instance, we had already calculated that A, B, and C would sell for 100, so therefore the extra 30 must be D. Agreed? All right. The next case, C, scenario C, is the same thing, but where they're now saying that the residual approach is inappropriate. So let's look at what they say. The same facts apply, except for the price. The price is now 105 Rand instead of 130 Rand. So if we followed that approach, we would come out with a price for D, which would be 5 Rand. Do you agree? If I followed that approach. So if my price was 105 and I followed that approach up there, if I put the numbers in, so if this was 105 and I followed this approach, this would be 5, this would be 60, this would be 40. And then this 5 looks wrong, isn't it? Because what do I normally sell B for? Anything between 15 and 45. So when I try the residual in this case, the residual is not working out, isn't it? It's not a good number. So when the residual doesn't work out like that, when it's not, it says the entity concludes 5 Rand would not faithfully depict the amount of consideration, then we have to look at a different way of trying to do the allocation. And what they do is they go back, or they would have to try and find a basis and go back to selling prices. So they would have to try and identify or approximate a standalone price for D using another method. So that's what they'll end up saying. They don't actually do a calculation. So they say here the entity would have to estimate the standalone selling price of D using the suitable method, and then they would allocate based on those prices. Okay, so allocation of price. The most common is using market prices of individual items, because if you have been able to identify them individually, it's probably because you do sell them individually, isn't it? And if there is a discount on top of that, we would just apportion the discount. You saw that calculation. All right. Then example 7 is an example for the step 5, which is recognition of revenue to see when a performance obligation is met. So Italiano is the owner and manager of health clubs. They enter into a contract with the customer for 1 year of access to any of its clubs. The customer has unlimited use and he promises to pay 100 Rand per month. Italiano determines that its promise to the customer is to provide a service of making health clubs available for the customer's use. This is because the extent to which the customer uses the clubs does not affect the remaining number of goods and services to which they're entitled. The entity concludes that the customer receives and consumes the benefits in making the entity's performance obligation is satisfied over time. Yeah, right. I suppose that's a fairly obvious one. Throughout the year. Yeah, so they recognize it over time, so they would recognize 100 Rand a month. I suppose we had already sort of been through the different service options. Costs that, okay, that's costs. Costs that give rise to an asset. Okay, so sometimes, I'm not going to look at this example. I think I copied it, but I don't think it's that important. Sometimes there are costs incurred and we can't yet recognize revenue. So we would recognize them as an asset as long as there was probability that we would be able to recover them at a later stage. We can quickly have a look, I suppose, at the example. So they say an entity pays an employee 10,000 Rand sales commission, signing a contract which goes for 5 years. So it's a 5-year contract, renewable for 1-year periods, and they paid a 10,000 Rand commission. Before providing the service, they build a technology platform. This platform is for internal use, and it interfaces with the customer system. The initial setup costs relating to the contract are, for the technology platform, are as follows. Design, hardware, software, migration, total costs of 350. And then they talk about, they say, discuss how you would account for these costs. So they say that the initial 10,000 Rand for the sales commission, you're going to recognize as an asset initially, isn't it? And then you're going to recognize the expense over the 5 years. It kind of would make sense if I said to you, what do you think you should do with it? That's what you would have come up with. The entity will amortize it over 7 years. Oh, they said 7 years because that's the average of the contract. Then the hardware costs. Hardware is PPE, so that's not an expense. Software costs are intangible, so those are not expenses. The costs of design, migration, and testing. We assess whether these costs are an asset to be recognized in fulfilling the contract, and if so, they would also be amortized over the period. Essentially, that's what they say there. These journals, I think, are similar. No, this is just income received in advance. I don't know why. They call it a contract liability and receivable. But we saw these incomes received in advance when we did tax in the beginning, isn't it? We saw a lot of those. An entity enters into a contract to transfer a product on the 31st of March, and they have to pay 1,000 Rand in advance. So in the beginning, we just receive the cash and we create income received in advance, isn't it? They call it a contract liability, but it's income received in advance. Then when March comes, the 31st of March comes, we then recognize that as revenue. So that's a straightforward example. A non-cancelable contract. The same facts apply, but it's not cancelable. When it's not cancelable, we recognize, why a receivable? Oh, okay. Contract liability. Yeah, I don't know. This is a funny journal. So when we enter into the contract, we immediately recognize a receivable because it's a not cancelable contract. But the other side is income received in advance. So it seems like a funny journal, isn't it? Income received in advance, receivable. But then when we receive the cash, it goes cash receivable. And then when we meet the conditions, it goes liability revenue. I don't know. These are funny ones. Yeah. Okay, so that's the, let me go back to the beginning. That's, I just copied all the examples. That's revenue recognition. Revenue recognition. Step 1, identify the contract. Step 2, identify performance obligations. Step 3, determine price, allocate price, and determine when the obligations are met. So you could get in an exam a theory question, isn't it? A discussion question. What revenue can be recognized, or how or when revenue can be recognized, how much revenue can be recognized. But you also get in exam questions journal questions, yeah, where they ask you to do journals. So I thought we could maybe, anybody print or have the October 15 exam? No. I thought maybe we could look at that one, but maybe we can start off by looking at May. To plug it in. Okay, we're going to do a question. In the May 15 exam, there was a question for 21.5 marks for journals. It isn't just revenue journals. Some of them are revenue journals. Some of them are error journals. I just need to find the paper, which means I have to go here and print it. But I know that for some reason, students struggle with journals. Am I right? I don't know. So 21.5 marks for journals. I'll just print the whole thing. Print. Okay, so this is the May 15 exam. That's what the questions were. Question 1 was accounting policies, changes in estimates, errors, and tax. Then question 2 was framework, accounting policies, changes in estimates, errors, revenues, events, provisions, contingent liabilities, contingent assets, and fair value, all in one. That's more or less how the exam questions will be. 2 big questions, mixed up. And the one that we're going to look at today is question 2. So if we look at question 2, it has 2 independent parts. Part 1 has a number of scenarios, and you can see that they have 10 transactions. Here they have a customer who placed an order, a customer who was liquidated. We sold security systems and received a commission. We installed cameras that didn't meet some requirements, and we're being sued. There's a 3-year contract to provide security service. So you can see it's revenue, bit of provisions, but a lot of revenue in this question. 10 transactions. The required A says prepare the journal entries in the accounting records for transactions 1 to 10 above. And that is for 21.5 marks. They then also ask you to disclose transactions 7 to 10 in the notes, and these transactions 7 to 10 have to do with changes in accounting policies, errors, events, and provisions. So if we quickly look at 7 to 10, 7 is a change in accounting estimate. They're changing the depreciation policy. 8 is a claim for negligence. 9 is an event after reporting date, it looks like, because it was done in August. And 10 is a provision for training, it looks like. Due to a new computer program, sales personnel had to attend training courses. Provision. Okay, so that's 21.5 marks for the journals, 16.5 for the notes, part A. Then part B is a little bit of framework. I think it's IFRS 3 and framework. IFRS 13 and framework. 4 marks for IFRS 13, 6 marks for framework. Small part of the question. But I'm going to leave this part up here, this question. And I'm going to let you get started. I'm going to go make copies. So we have to do journal entries for 21.5 marks. Your journal entries don't need narrations, I think they said. No narrations. But I do no abbreviations. All calculations must be shown. Yeah, you don't need to do narrations, but you need to put in brackets after each account, whether it's SFP or P&L, so that they want you to do that. And they also then say no abbreviations. So just be careful with that. Don't say AC, DEP like that. You have to say accumulated depreciation. Okay. All right. So let's see. I think the initial ones, these initial ones, will be revenue. Go back. Okay, shall we have a look? Oh, it's come out really small. It doesn't help us. Let me just go back and go view off. Okay, so the first one is when a customer placed an order for an installation of a gate. He paid 30,000 Rand on that day. He chose a specific design and it had to be specially manufactured. And there was a period of 6 weeks from the order date until installation. It was only installed after the year end. They wanted the journals up to the year end. Is that right? Which was June. So the journal entry to debit bank, because we received the money, and to credit income received in advance, or they call it a contract liability, isn't it, in that one journal? But anything like that for the 30,000. Agreed? Yeah? Okay, so that was income that was received, 30,000 Rand on the 26th of May. He paid in full the 30,000 Rand on the 26th of May, but we only installed the gate on the 5th of July. So we're going to account for that as income received in advance or contract liability, and leave it in our financial position. The second one, a major customer was liquidated. He owes us an amount of 84,000 Rand, which is included in receivables, and the liquidator said there would be an estimate of 20 cents on the Rand, which means that the 80 cents we're going to write off, isn't it? So we have to write off a receivable. So debit bad debts expense, credit receivables for 80 cents in the Rand, 80% of that balance. The rest, the 20 cents, can stay as receivables. Hopefully we'll get paid out on liquidation. Agreed? The third one, we sold security alarms on behalf of another company for 45,000 Rand, and we received a commission of 15%. They paid this commission on the 31st of May. So we're going to account for the commission, not for the gate. It's not our gate, right? Or our system. It's somebody else's. We only need to account for the commission received, and it goes debit, bank, credit, commission received. Or it can go revenue, whichever one. Revenue, commission is revenue, so you can either call it commission or revenue for 15% of that balance. Okay. Then number four, somebody sued us, a company called Bless, because certain security cameras were installed on their premises, didn't meet the specifications. The case will be heard in court on the 15th of August. So we have been sued. The case hasn't been heard yet. The security cameras were faulty at the time that the armed robbery took place. The attorneys have notified the director that it's probable that we will lose the case and we will be found liable for costs and compensation of 300,000 Rand. So it is a liability. Do you agree? There is a present obligation, and there's just uncertainty about the amount that we will have to pay, but it looks like the attorney is saying we will lose the case, isn't it? So there is a liability. There is a present obligation as a result of a past event. Cameras were faulty. We've been sued. There is a probable outflow of economic benefits. We will have to pay according to the lawyer. And the only uncertainty is the amount. So it's therefore a provision. So I'm going to create a provision for claims of 300,000 Rand, and it's going to go into expenses in my P&L. Sorry, I'm going the wrong direction. Number 5, we concluded a 3-year contract to provide 24-hour security services from the 1st of June at an annual fee of 450,000 Rand, escalating at 5% per annum, payable in advance on the 1st of June. So we've received that 450,000 Rand on the 1st of June, but it's for a monthly contract, isn't it? So at year end, we have only provided services for the 1 month. Yeah, or you can even say it's an hourly contract, whatever you want to say, but it's for 24 hours. We've been paid 450 for the whole year. So of that 450 that we have been paid already, because it's payable in advance, we will record 1 month as revenue, the rest of it as income received in advance. So debit bank for the 450, credit revenue received in advance, and then I've taken 1 month and recognized it as revenue. You could have put this as a net entry if you'd wanted to, because both sides of that journal go to revenue received in advance. Yeah. So bank 450, cash in, revenue 37,500, 1 month, I can recognize as revenue. The difference has to stay in statements of financial position to be recognized when the services are delivered, which is in the next year, the next financial year. Number 6. Due to the extent of their inventory losses, they installed security cameras in their warehouse. They accepted a quote for 120,000 Rand for the security cameras. The installation of the cameras was completed on the 10th of June, and the outstanding amount immediately settled in cash. We gave them a discount of 24,000 Rand to ensure good business relations with them in future. That 24,000 Rand we can't recognize as revenue, isn't it? So we recognize the net amount as revenue, which is the 96. 120 less the 24. Then, sorry, we're going forward. Number 7 was a change in depreciation method, isn't it? They decided to change the depreciation from reducing balance, to reducing balance from straight line. The carrying amount at beginning of year was 252. The original cost had been 420, and we're going to change depreciation methods. Here's my calc at the bottom. So change in estimate, old, new is the way we do the calc. Old, the original cost was 420. Beginning of year, we were down to 252. We're writing it off over 5 years, so it's 20% of that number. Divide by 5, 84. The new starts with 252, and now we're going to do reducing balance, 20% on that balance. So the difference between those two depreciations is 33,600, isn't it? So the journal entry to account for the, sorry, I was on the right page. The journal entry to account for the additional depreciation that needs to be charged, or no, a reduction in depreciation. Is it a reduction? Yes, it was a reduction in depreciation, is to credit the P&L depreciation charge and to debit ACDEP, because I'm dropping depreciation from 80-something to 50-something. Okay, then number 8, on the 10th of June, an automated gate was installed at a factory and it derailed. They've instituted a claim for negligence. The date of the court case has not been determined, and the advisors are of the opinion that the claim will probably not succeed. It's not a liability, do you agree? So it can't be a provision, because a provision has to be a liability. This one is not a liability. The probable future benefits is just not there. So therefore, it's a contingent liability. It will require disclosure, because it's a possible obligation. Yeah? And so therefore, for your first required, there was no journal entry. I don't know if there would even be a mark for saying no entry, maybe. Yeah. The second one is an event after reporting date. On the 21st of August, after year end, the marketing director announced that he's going to decrease the selling prices in order to increase market share. This will result in an increase in profit before tax of 420,000 Rand. It's a question here whether this is anything at all, actually, to me. It is an event that's occurred after reporting date. It's something that maybe, I don't know, because they haven't said to you, affects the carrying amounts of your inventory at reporting date. I don't know. But it's definitely not a journal, right? So in terms of journals, it's a nothing. In terms of disclosure, I would question whether a reduction in selling prices is something that's even an event after reporting date. Yeah, it's definitely an event after reporting that affects things that have arisen after reporting. So if it's considered to be material, you might disclose it. So maybe they consider it to be material. I mean, I don't know. And then number 10, the last one, says due to a new computer program for capturing data, the personnel had to attend a training course, and the training course is going to be presented in June and in July. The provision for the courses already attended in June was 56,000 Rand. The invoice was paid September, and it was 66,000, consisting of 48 for the training courses and a computer program of 18. But now this is last year. You picked up, hey, that this was last year. Yeah, so this is a provision for last year, and then we paid the 66 this year for that 56 of last year. Did you see that, the dates? Okay, so when we paid this 66, it was 48 for the training courses, 18 for a new computer program, so that needed to go to computer programs. The 48 needed to go against this 56 that we provided, and the remaining 8 needs to be written off, isn't it, or reversed. Do you agree? I had a provision of 56, I used 48, the 8 gets reversed, and then I paid an extra 18 for PPE, for a computer program. PPE or intangibles. So my entry is to reverse the provision of 56. Oh no, that entry is wrong. See, I just went and that entry is wrong. Now I'm looking at it. Is that the one that you have as well? Yeah, it is, because that's what I printed. Is yours different to that? Or is that what yours says? You see, but yeah, I have the correct provision calc.
Wouldn't you have reversed it last year?
Let me just read what it says about that computer software. Man. For the training courses of the new computer program, and 18,000, it's not a computer program, 18,000 for a motivational speaker. Okay, that's why I put the whole 10 to P&L. Okay, so this 10 that went into P&L, you could have, I suppose, put it in as going two different ways. It's a 18,000 Rand expense for the promotional speaker, for the speaker, not promotional, motivational speaker, and it's a -8 reversal for the training expenses, giving you a 10 expense. Okay, so it is correct. Okay, how did you find journals? Okay. So I'm sure I've said this to you before. Every exam will have some journals, some presentation, balance sheet, income statement, some notes, some calculations, some discussion questions. So unusual to find so many marks for journals, 21% of the paper. It's quite a lot. But there would always be some journals, and revenue is one where they do like to ask the journals. Right, so from next week we're going to start working through those past exam papers. We're going to start with October 15, which is the one that we don't have solutions for. And we're going to all work together and hopefully come up with a suggested solution for that one.